Today I would like to analyze BYD, one of the largest electric vehicle companies in the world and one of the best performing stocks in the last 6 months. We are up around 78%. So we're going to take a look at the financials to find out if it's a good buy right now. The first thing we can recognize is a market cap of 174.99 billion US dollar. This makes BYD the second largest electric vehicle company in the world by the market cap. But if we take a look at the market cap, there is still a big difference between Tesla and BYD, even though BYD sells more electric cars. We also have a dividend yield of around 0.93%, which we can see here did increase in a very good rate in the last 10 years. Now we're going to take a look at the financials. The first thing we're looking for is revenue growth in the last 5 years. You want to invest in a growing business and not a declining business. So in 2020, the revenue was around 156 billion Chinese yuan. This was a 22% increase from 2019, so very good growth. In 2021, we saw even better growth, around 38%. Then in 2022, we saw the incredible growth, around 96%. Then in 2023, we saw the very good growth, around 42%. And then in 2024, we saw the good growth around 29%. So overall, what can we say? I think this company is growing in a very good rate in the last 5 years. So it's a check here. The next thing we're looking for is free cash flow growth in the last 5 years. So free cash flow is very important because it can be used to pay the dividend, to pay the stock buybacks, to invest in the business, and also to pay back the debt. So in 2020, the free cash flow was around 33.6 billion Chinese yuan. Then in 2021, we saw the decline around 16%. But if we take a look at the operating cash flow, we can see an increase around 44%. So we can see here the reason for that is a higher capital expenditures. This means the company invests more money into the business. Then in 2022, we saw the free cash flow growth around 54%. This is a very good growth rate. In 2023, we saw around 10% growth. This is also good. Then in 2024, we saw the decline around 24%. So the reason for that is that this company has a higher change in inventory, so they're buying more products. So the next thing we can say about this company, I would think they have a good free cash flow growth in the last 5 years. So it's a check here. Now we would like to see the free cash flow yield over 4%. This can also tell us about the valuation of this company. The higher the free cash flow yield, the higher the indication for undervaluation. So we're going to take the free cash flow from 2024, 36 billion Chinese yuan. We're going to divide it with the current market cap, 1,260.68 billion Chinese yuan. Then we're going to get the free cash flow yield around 2.85% for 2024. So this is under the 4% that we are looking for, but we also expect the free cash flow to grow in the future as well. We can see here the assumptions for 2025 would be around 57.9 billion Chinese yuan, in 2026 around 75 billion Chinese yuan, and in 2027 around 89 billion Chinese yuan. So let me know in the comment section if you think these numbers are realistic. Let's assume for 2027 we can reach around 80 billion Chinese yuan. So we're going to take this number, 80 billion, we're going to divide it with the current market cap, 1,260.68 billion. So then we're going to get the free cash flow yield for 2027. So the number we're going to get would be around 6.34%. So this is over the 4% that we are looking for, and it could be an indication for undervaluation, but only if these numbers are realistic for the future. The next thing we're looking for is a debt to free cash flow ratio under 5. This means the company can repay the debt with a free cash flow in under 5 years. So this is a very important number because if a company has too much debt and cannot repay the debt, it can risk to go bankrupt. So first we're going to take a look at the long-term debt. We can see here around 8.2 billion Chinese yuan. We're going to add the short-term debt as well. We can see here 12.1, but we need to add this number as well, the 8.2. So all in all, it would be around 20.3 billion Chinese yuan for the short-term debt. Then we're going to divide it with the current free cash flow. This is around 36. Then we're going to get the debt to free cash flow ratios that we're looking for. So the number we're going to get would be around 0.79. That's a great number actually. It means in under 1 year we can repay the debt with the free cash flow. So the check here. Then we can also take a look at the cash on hand, how much money this company has in the bank. We can see here around 143 billion Chinese yuan. This is a big amount, and I think this company has a great balance sheet. The next thing we're looking for is the enterprise valuation to free cash flow ratio under 25. So this can also tell us about the valuation of this company. The lower the number gets, the higher the indication for undervaluation. So we want to see a low number here. First, we're going to calculate the enterprise valuation. This is the current market cap, 1,260.68 billion Chinese yuan. We're going to add the debt as well. So the debt is around 28.5 billion Chinese yuan. Then we're going to take minus the cash, 143.24. So then we're going to get the enterprise valuation of this company. So how much the whole company is worth. So the number we're going to get would be around 1,145.94. This number we're going to divide with the current free cash flow. This would be around 36. Then we're going to get the ratios that we're looking for. So the number we're going to get would be around 31.83. So this over the 25 that we're looking for. So this would be not a check here, but we can also calculate this number for 2027. We expect the free cash flow to grow in that time. So we're going to take the 80 billion for the free cash flow. Then we're going to get a different number for 2027. So the number we're going to get would be around 14.32. So this number looks way better already, is under the 25, and is definitely indication for undervaluation, but only if these numbers are realistic. The next thing we're looking for is shares outstanding decrease. This means the company buys back their own shares. We like to see that especially we think the company is undervalued. So we can see here the shares outstanding actually increased over the years. This is something normal for the younger companies because they still want to grow in the future. So they invest more money into the business. So it's not a check here, but I don't think it's a problem. Can BYD stock be a good buy right now? So let's start with the positive. We saw strong revenue growth in the last 5 years. We also saw the strong free cash flow growth as well. This is something we really like to see. The balance sheet is also looking great. This means a low amount of debt and a good amount of cash on hand. The free cash flow yield around 2.85% is looking quite low, but we also expect the free cash flow to grow in the future as well. With our assumptions for 2027, the free cash flow yield could be around 6.34%, which would be an indication for undervaluation. Our enterprise valuation to free cash flow ratio around 31.83 is looking quite high actually. We want to see that number under 25, but we also expect the free cash flow to grow in the future. With our assumptions for 2027, this number would be around 14.32, which would be an indication for undervaluation. We have a dividend yield around 0.93, but this is not very high, but we had a very good dividend growth rate in the last 10 years. Overall, I would say this company can be a good investment, but this company also has a lot of hype right now. We are up around 78% in the last 6 months. So overall, I would be carefully right now to invest in this company. If you found this video helpful, don't forget to like and comment and subscribe for more content.